Hi there, Paul Ferrarisi with Founders Group. Thanks for stopping by. We've got some educational information we want to share with you. At the end of the program, if you want more information on it, we'll explain how to get it. Thanks again for stopping by.
Today I want to talk with you about tactical money management. Now, this is a 30,000 foot overview of the concept. If you'd like more information at the end of the program, please contact us. We'd be glad to give you more details. So here's how it works. Our company here, Founders Group, well, we're very blessed to have a lot of clients that want to get into tactical money management. But as you see on the screen here at the very bottom, we brought out a few examples of some of the money managers that we work with. Many of these money managers won't even pick up the phone if the client is not ready to invest some of them want a minimum of $10 million to get started with. So what we've been able to do, we've worked out a great arrangement. And as you see in the middle of the screen, First Advisors National is an SEC registered investment advisor that we've been able to work with. And we've been able to funnel our clients' monies, group the monies together to work with these professional money managers. The managers really don't care where the ticket comes from, the 5 or the 10 million. Maybe somebody's only got 300,000 to invest, another one 3.2 million, another one 50,000 to invest. But we pool the money together to go to the money manager. Once the money manager has their minimum ticket met, then they manage each person's portfolio individually. So you'll see the funneling effect there. You'll see Folio Institutional. We need a custodian to hold the funds. Custodian, Fidelity is a custodian, Vanguard, Schwab, E-Trade, these are custodians. You've probably never heard of Folio. They're basically set up for institutional money managers. And then from there, after we work with the client and design out their portfolio, we will pick those money managers that meet their particular needs. Now, this information that we have here is just strictly for illustration purposes. There's no guarantees whatsoever. FAN is an SEC registered investment advisor that has to follow the rules, always do what's in the best interest of the client. This is the basic fiduciary rule. Everybody said, well, isn't that what every money person is supposed to do? No, most of the brokerage firms have to follow what's called the suitability standard, which says, is this investment suitable for the client? Here, this is what's known as the fiduciary standard that we're required to always follow by. And FAN, like ourselves, are committed to the best possible investment advisory services and education for all of our clients. Now, most people have been led to believe there's only one way to invest in the stock market. Well, I invest in the market, and this is the old buy and hold strategy. I've got to live with the ups and downs that happen with the market. Well, that's the old traditional way. Many people still do that today. But actually, there are two very distinct and very different ways to invest in the market. One is known as strategic, and the other one's known as tactical money management. In the strategic approach, most people are used to that. That's the old traditional approach, common to mutual funds, exchange-traded funds, and stock investing. That is, I put my money in, and just it's the buy and hold. I live with the ups, I live with the downs, I live with the losses, I live with the gains along the way. Most people are unaware of an important subject when it comes to mutual funds. Although you may have your mutual funds in a qualified plan like a 401k or maybe in your own brokerage account, and I'm sure everyone has read every single page of each prospectus of each mutual fund, buried within it are the rules that they set up. And these things are submitted to the SEC, and it basically becomes the law of the land. And what it means is all mutual funds kind of follow a code in which they state that they will never have more than 10 to 12% of their money in cash at any one time. So that means I've got about 90% in the market. The problem happens when there's a market correction, because if they've only got 10% of their assets in cash, and you've got a huge number of people that are getting nervous as the market is dropping and they want to cash out. Well, the mutual fund doesn't have that money to handle it. So what do they have to do? They've got to go out there and sell some more shares, which they hold in the mutual fund. And don't think that it's only one mutual fund. You got 12,000 different mutual funds that are sitting out there, and they're all getting the same call by all of their clients. So this pushes the market down even further and creates more selling and more drops in the market. That's the problem with buy and hold. On the other hand, those of people that have exchange traded funds, they have no cash. They are geared towards an index, which means they must be 100% in the market at all times. And the largest number or amounts of money are sitting in exchange traded funds that have not gone through a significant bear market to date. So the traditional buy and hold approach is great on the upside. Let's go back during the booming periods during the decade of the 90s. Your $100,000 over that time period grew to $423,000. Fantastic. Averaged about a 14.5% annual rate of return. Unbelievable during that time. But as waves move along the way, if I go through a decade that great rates of return, they're soon followed by the downside, the bad rates of return. Here was the following decade from 2000. We remember the tech wreck from 2000 to 2003 and 2008 to 2009 period. That 100,000 10 years later was now as low as $79,000. That was the ending decade value. It was also known as the lost decade over this time period. So what is tactical money management? It involves active professional money management, which is constant attention by a professional manager. Well, isn't that what the mutual fund or the ETF? No, ETF is an index. They set it and forget it. On a mutual fund, they'll buy for a period of time, and they may hit some limits. The professional money managers that we deal with are not staying awake 24 hours a day. They have computer algorithms that will fill in when they've hit their signals to get out of the market or get back into it. There's the flexibility of using multiple asset classes, not just stocks and bonds, can be real estate, can be alternative investments there. They follow trends and indicators. It's not timing. What do I mean by timing? Oh, there's old adages on Wall Street. Sell in May and come back after Labor Day. That was an old adage back in the 50s and 60s. Or, oh, we don't want to miss the Santa Claus rally. That's timing. That's not timing. They're following trends and indicators. They're watching money movement into the market and out of the market. How does it work exactly? Well, they can't tell us, otherwise we wouldn't need them whatsoever. Here's the best part about tactical money management. The ultimate asset protection, 100% cash. What does that mean? When they get a signal that says, hey, bad times are coming, they can take all of your portfolio and move it into cash. Let the storm pass and then come back into the market. That's something that buy and hold cannot do. Now, some people will do a tactical money management using buy and hold, and what the typical investor does is after they've lost 40 to 50% in the market, they get so frustrated, they get angry, they sell out, and they move to cash at the bottom of the market. And then when the market gets way back at the top, they come back in. They're doing the opposite of what they're supposed to do. Tactical money management uses a mathematical, scientific, unemotional approach to investing. Many people don't want to do tactical. I'll just get out when it drops. Fine. What is your exit strategy? What is your plan? How are you going to execute that? So the main thing that tactical money management tries to do is asset preservation, at the same time asset appreciation. So two basic goals people have. I want to make money and they don't want to lose money. And what we want to introduce to you is what we call the 80% target rule. This attempt tries to capture 80% of the up market and at the same time avoid 80% of the downside of the market. Now, they may be more successful than other traditional investment strategies such as the buy and hold. We want to show you information here. You make your own decision from the information we're going to pass on to you. As opposed to the traditional buy and hold, the 80% target approach attempts to participate in the positive performance and mitigate losses from the negative performance. And that's the key role, is eliminating as much of the losses as you can. You'll see it with the empirical evidence that we have here. So the approach of tactical money management, it's access to multiple investment options. We've got variety of professional money management, diversified portfolio, and a broad range of asset classes, including cash also. Now, they continually evaluate. Again, I say to you, this is not market timing. They do regular rebalancing to enhance their performance, and they mitigate losses by understanding and reducing risk. So, what's mitigating losses here? I think most of you know the math, but let's do the simplest one of all. If we go to the left-hand side on the bottom, if you lost 50% of your money, too many people that are investors think, well, I just need 50% to get a gain. No, that's not true. If my 100,000 portfolio drops to 50,000, I need a $50,000 gain or 100% gain just to get back even. And in the meantime, I've lost a lot of that gain on the return trip back up. So some strategies that we talk about says stay fully invested. This is the buy and hold in order to capture all the gains. But what happens when I also have to capture all of the losses? Well, I'll just get out when the market drops. Very few people listen to any bell ringing, and there is no bell ringing at the top of the market. So here's an example. And I like this example to get the point across to you. Here's our example. We've got 100,000 invested in the S&P, and it's going to follow the buy and hold strategy. And we've used a time period 1994 to 2014. Now, fully invested, that is buy and hold, go with the ups, go with the downs. After that 20-year period, it grew to over 339,000. What we're going to look at now, let's compare. If we were using some form of tactical money management, what happens if we weren't that good and we missed the best days of this 20-year period, the best performance on the market in the days that it performed the best, and also looking if we were able to avoid or miss out on the worst days as the market dropped. So, as mentioned earlier, by buy and hold, our 100,000 over that 20 years grew to $339,000. What happened if we missed in the tactical money management? We missed the 10 best days as the market was going up over this 20-year period. The 10 best performing days. Well, gee, our portfolio would have grown to only $119,000. Well, that's why I stay in the market all the time. Well, it sounds good when the market's up. Let's look at something else. Same token. Same 339,000 by the buy and hold over the 20-year period of time. What would have happened if we avoided the 10 worst or the 10 worst down days in the market? Well, that same 100,000 would be worth 844,000. So let me repeat this. By following the buy and hold, I've gone way, way up. I've come down, go up and down, go through the ups and downs. At the end of the 20 years, my portfolio would be worth $339,000. If during that same 20-year period I missed the 10 best days in the market, I would have underperformed the buy and hold. But if I mitigated the losses on the 10 worst days in the market, I would have more than doubled what I had in my portfolio. And let's take it one step further. Looking on the left, what happens over the 20 years if I missed the best performing 20 days in the market? Well, geez, my 100,000 starting would only be worth 36,500, like 10% of the value of the buy and hold. But what happens on the right-hand side of the ledger if I miss the 20 worst days, the 20 down days over that 20-year period of time, that 100,000 would be worth 1.5 million. So buy and holds 339 during the good periods, the bad periods. We emphasize avoiding the losses is more powerful than missing the gains, because if I avoided the 10 worst days, I still would have had 844,000. If I avoided the 20 worst days, I'd have 1.5 million dollars out of that same 100,000 over 20 years. So avoiding significant losses has a way to significantly increase the account value. Now, the hypothetical illustration, we're going to take one more example. This is more current, 2000 to 2017. What happens if we participated and got 80% of the positive uplift of the market and we avoided 80% of the down movement in the market? Well, with the buy and hold over the 17-18 year period, that 100,000 would have grown to 221,000. But if I only captured 80% of the rise and avoided 80% of the losses, it would have been equal to 346,000. Now, this graph is not to scale, but let's go back to the deadly period 2007 through 2009. We see the buy and hold drop precipitously. The tactical money management, folks, they don't miss and get out at the tippity top, nor do they get in at the very bottom. They can't. But they have minimized the losses that are there. And that's what we're looking for, is to minimize the losses while capturing the majority of the gain. As one renowned investor always said, rule number 1 is don't lose money, and rule number 2 is don't forget rule number 1. But can this really be done? Sure it can, folks, and it's been done many, many times. By way of a background information on there, by way of background, there are costs that are involved. The average mutual fund, even dealing with Vanguard and some of the others, they may talk about their expense ratio, but there are internal costs that are in there. The average mutual fund has a cost of about 3 to 5% per year. Average 401k plan has a cost of 1 to 3.5% per year. Now, if you were going to go out in the street and find a professional money manager, their costs run on average about 1 to 1.5% a year, inclusive. That includes all trading costs and things of that nature. Now, our tactical platform has a cost slightly above a professional money management. Any manager off the street using tactical money managers, the cost runs about 1.5 to around 2%. Well, why does it cost a little bit more? Well, the same way if you look at your homeowner's insurance policy, you pay a fee, maybe 0.5% to 1% of the value of the home, to insure and protect that asset against loss from fire, or maybe possibly for flood if you have flood insurance, or damage that may hit that. Well, the same way here, this is the extra premium that you will pay to offset and ensure that you're not getting involved in all of the losses by a typical professional money manager, or in a 401k, or the average mutual fund. So there's a slight premium that's involved, but it's well worth it. Now, the first step, if you want to look at tactical money management, is to understand the current risk of your portfolio. The second one, once you find that out, is ask yourself, do you want to continue with buy and hold, or use the strategy that we've been using for many, many years, known as the 80% target? Well, that's my information I have for you today on tactical money management. If you'd like more information on it and get into the real details of it, by all means, contact us as soon as possible, and we'd be glad to help you.
Well, I hope you found that information helpful. If you feel your family, or friends, or coworkers might also benefit from it, please share this link with them. Now, if you want more details on this, at the end of the video, we'll share that information with you. Thanks again for stopping by. Bye for now.